Hi, I'm Mike and this is Mikeonomics. In this episode I want to start the rather large and daunting task of explaining the UK banking system and how it operates. Most countries' banking systems operate in exactly the same way, but there are slight differences, which is why I'm stating UK banking system, but you can apply this knowledge to almost any country. The traditional view of a bank is one that receives deposits and savings from customers and lends that money out to businesses and mortgage borrowers. The loans generate interest payments from the borrowers to the bank, which the bank uses to pay interest to its savings and deposit customers and keeps the rest as profit or shareholder dividends. This could be seen as a custodian model where the bank is entrusted to keep our money safe and use that money to provide useful investments into the economy. While this does form part of a bank's operations, it's a very small part and by no means functions in the way most people seem to believe. To explain how a bank operates, first we need to understand what a bank's business is. We all know that a bank's business is of course money, but do we all really know what money is? So money enables us to exchange something with another person for a known and agreed value. Before the existence of money, the only way of purchasing something was to barter, such as trading 10 chicken for a cow. The person with chickens may have many more at home but no cow, and the person with a cow has a herd of them but no chickens. So this exchange is only possible because each party has something the other one wants. With money, I can buy the cow at an agreed value without having anything that the owner of the cow wants, because the owner of the cow can then take the money and exchange that for chicken or anything else that he wants and can find for sale. So money is therefore a commonly accepted medium of exchange. Money didn't just make trading easier, it also provided the ability to save. Before money, a milk farmer would have to exchange his milk for other items before the milk went sour. There may be plenty of people wanting milk, but if they don't have anything that the farmer needs or wants, the farmer may be forced to exchange milk for something he considers to be less value than the time, effort and resources he spent creating it, or he risks the milk going sour and it going to waste. Now, obviously, he could diversify into cheese, but it's just an example. So by trading milk for money, the farmer is able to store the value, which can be exchanged at a later time for something else. So money is therefore also a store of value. In the Bronze Age, around 3000 BC, bronze, iron, copper and tin were traded between craftsmen and merchants along trade routes and seaports. The value of the metal was determined by the weight, which was often stamped on the ingot. The metal could be crafted into tools and weapons, so therefore it had intrinsic value and was widely accepted as a medium of exchange, even by those who had no direct use for the ingots themselves. The cost of the ingots is derived from the amount of time and effort it took to mine and refine the metal, and the value of the ingots came from their utility in making tools and weapons. This value could be stored by the owner until he wants to trade that value for something in the future that he has more use or desire for. This form of commodity money was a huge leap forward from bartering, but it had its downsides. Most metals do corrode over time, so there's a limit to how long the value can be stored, and the relative abundance of these metals meant that huge quantities would be required to store a large amount of wealth. This would obviously make storage and transportation very difficult, but gold and silver provided the solution. Throughout history, gold has always been coveted by civilizations, and rulers across all time appear to have been obsessed by obtaining as much of it as possible. There appears to be no practical reason for gold to have been desired so much in the past, other than its decorative qualities. Gold is one of the few metals found in almost pure form. It doesn't corrode and it can be melted over a flame, which makes it easy to work with. On a structural level, the atoms in gold are heavier than other metals, which makes the electrons move faster, resulting in gold interacting with light like no other metal. These qualities, as well as its relative scarcity, is why gold, and to a lesser extent silver, has been used as a store and a display of wealth for as back as we can see, but it wasn't until gold began to be smelted into uniform size and purity and certified by the state that gold began to be used as money. From that point, metals have been the predominant form of money: gold for large payments and transfers, silver for intermediate sized transactions, and coins of copper or a mixture of other metals for everyday use. In the UK, as recently as 1946, most of the coins in circulation were 50% silver, and prior to 1920, coins were 92.5% silver. Today, because of the price of silver, those coins are worth far more than their face value, so if you have any, hold on to them. They are likely to become even more valuable due to the current economic conditions. The history of money is fascinating, and I'll cover it in more detail in another episode, but one thing is clear: history most certainly repeats itself. So why don't we use gold and silver as commodity money today? Economists would argue that it's because there isn't enough of it to satisfy a growing global economy, that gold could not be mined quickly enough to keep up with the increasing levels of goods and services available to buy. Now, this may sound logical, but it's a prime example of smoke and mirrors and false assumptions that plague banking and finance. The real reason we don't use gold and silver as commodity money today isn't because there isn't enough of it, it's because certain people didn't have enough of it. Just as a side note, this is where we get the concept of monetary policy from: central banks controlling the money supply, controlling the amount of money within the economy. I'll demonstrate another time why intervention in the money supply is viewed by many as detrimental, and that the economy and price stability would work much better when pure market forces of supply and demand are left to work. One to look forward to. To demonstrate how history rhymes, thousands of years ago there were merchants who also felt that the money supply was too small, so they undertook the practice of coin clipping. They would shave off a small portion of each coin that passed through them and melted the shavings into new coins, therefore creating more money for themselves. Over time, the general population began to realise that the coins contained less metal than they should, and prices began to rise. It wasn't that goods and services became more expensive, they cost the same amount of metal as they did previously, it just took more coins to achieve that same amount of metal. This is inflation. In another example, goldsmiths were required to keep large amounts of their own gold safe, so were considered a trusted storage service for other people's gold. The goldsmiths would give out receipts for the gold in storage, which the owner of the receipt could exchange for their gold at any time. By doing this, the goldsmith is turning commodity money into receipt money. Once people grew confident that the receipt was indeed fully redeemable for gold, the practice of signing over the receipt to another person became common, mainly due to how much easier it is to transact with a paper receipt, rather than having to transport and verify the weight and quality of metal with each transaction, a service which the goldsmiths would provide when they took the gold into storage. It wasn't long before the goldsmith realised that people weren't coming in to collect their gold, and they had all this gold sitting there doing nothing. Perhaps they too felt that the money supply wasn't sufficient, so they began creating receipts not backed by gold to either use themselves in commerce or to give borrowers who would then pay interest. The increase in receipts was not matched by an increase in gold, so the amount of gold available to redeem was only a fraction of the value of the receipts that were issued. This is known as fractional money. When goldsmiths issued receipts to borrowers, it could be argued that they were creating money out of nothing, but it would be more accurate to describe it as creating money out of debt. This process was very nice for the goldsmiths, as long as people weren't redeeming their receipts for gold, but the effect of the increased money supply would have become apparent very quickly in the form of higher prices. Those who could create and spend this fractional money prospered, while others suffered through higher prices and a loss of real wealth and purchasing power. Once people began to question the ability to redeem the receipts for gold, it was only a short amount of time before this first instance of modern banking gave rise to the first instance of a bank run. The history of modern banking can be simplified as a transition from commodity money to receipt money to fractional money, reducing the fraction lower and lower until we have what we have today, which is fiat money, where the commodity backing is zero. For the bankers, as with the goldsmiths in the past, fractional money earns them just as much interest as commodity money, so the temptation for them to make as much as possible is too great. That story has been played out time and time again throughout history. Once a society makes the transition from commodity money to fractional money, the fraction which represents the reserves becomes smaller and smaller until eventually it is reduced to zero and becomes fiat. Fiat money has existed at many times and places in history, and every single one has failed. Modern money has been full fiat since August 1971, when the US President Richard Nixon temporarily suspended the convertibility of the dollar into gold and effectively abandoned the global financial system that the world agreed to in 1944 at the Bretton Woods Conference. So there's a brief summary of the history of money. I find it incredibly interesting, and I hope to go through some of the specific historic examples another time. I hope you now have a good understanding of what money is, what it has been, and the role that banking has played in shaping what we view as money. If so, you should now have enough of a foundation to be able to understand the details of the current system. I'll cover that in part 2, where I hope to explain how banks operate, where most of their funds come from, where they go, and how they are regulated. Until then, take care, thanks for watching. I'm Mike, and this is Mikeonomics.